Wanted to take a look at the stock market today, what's happening with the stock market today. Specifically, we've got two big events, and the stock market today is gearing up for those two big events. First, we're in the middle of earnings season, and it's been a pretty solid earnings season so far. Nothing really surprising there. But on Wednesday, the Federal Reserve finishes up its meeting. We get around 2:30 Wednesday afternoon, we get Fed chairman's response. Now, we've been getting a lot of inflation numbers that are sticky. Inflation is simply not trending downward, getting the Federal Reserve to a confident level. Interest rates have moved upward. This is affecting the stock market. The stock market today, broadly speaking, but also on Friday, we get non-farm payrolls. And I wrote an article on my Substack. If you want to read that, that's up there, regarding employment. I actually think that employment's going to start to slow down. It's a lagging indicator. I've got a few charts I want to show you there and how that's affecting the stock market today, throughout this week, and all through probably the next month. Given that, let's jump in. I think we're going to see some softening economic data, but inflation continuing slightly higher. I do not see stagflation, however. Let's jump in. Here's a look at SPY stock, showing you what happened with the stock market today. There was some slight selling at one point, rallied right back. Not a real catalyst event that would push the stock market much lower. Again, Wednesday, huge. How does the Federal Reserve perceive inflation? Now, my take is basically Federal Reserve is going to talk, but not walk. Here's the reason why. November 5th, Tuesday, presidential election. The Federal Reserve is not going to want to get in front of that in any way, shape, or form. They may talk inflation pressures, but they may also be off the hook. Now, they have a meeting on the 6th and the 7th of November. If there is any movements whatsoever, it will be on those days. Up until then, the Federal Reserve is not going to move anything. They may talk inflation, but they probably are going to tone back how they express interest rates moving higher. They're basically going to say, well, we're not 100% confident yet that we're getting inflation where it needs to be. And they'll probably continue to rattle that off. Today's market movements in the stock market, here's the thing. If the Federal Reserve does absolutely nothing, that could really ignite things, because we are seeing some consistent numbers with the economy. But we do have GDP numbers that came in slightly softer than expected. I expect employment numbers to remain slightly softer, but just continue. Where's the impetus or catalyst to push employment further? Now, personal incomes, personal expenditures. If you've been following me for any length of time, I defer to this chart always. This is the first chart that I always look at. Government expenditures, pretty much flatline. Business expenditures follow what personal expenditures do. And the reason why is simply this. Businesses don't necessarily build new facilities or oversupply their warehouses because they want to spur the economy. They respond to personal expenditures. Personal expenditures, as you can see from this chart, the green portion there, the blue portion there, follow personal incomes. If the rate of growth of personal incomes is increasing, so will expenditures. We're seeing modest declines, probably going to see a lot of sideways action in incomes. Expenditures will do the same. But here's something that's really shocking when you compare these. We just got GDP numbers last week. Take a look at this. Personal expenditures versus gross domestic product, pretty much hand in hand. So if you want to know what the next GDP number is going to look like, just follow personal incomes. Personal incomes moving higher. They're about 2.4%. That's just slightly below median. So we will see some economic growth, but not necessarily robust rocket ship growth. And that's something that's really need to be like sort of your thesis when you're considering what's going to happen with economic data coming forward. The next thing, personal expenditures versus the deflator. Now, the price deflator measures prices based on a previous period of time. And what we're seeing is first, you look at the personal expenditures and you see there's a correlation between the deflator and expenditures, but the breakdown begins from there. Not so much with GDP, of course, because GDP basically measures all economic activity within a nation's border. The deflator, businesses can sort of move things when it comes to prices, but we did have the big housing bubble sort of push that drove prices upward like they did. So the PC deflator, they kind of does follow the expenditures a pretty good amount, but there is a breakdown compared. My take on this is we'll continue to see some price pressures, but they'll start to slow down somewhat. But that's going to be driven by the fact that we're seeing a slowdown in economic activity, growth, but not a recession. And the thing is, if you take a look at employment numbers, how much more employment can we get? We're at 3.8%. We're well beyond what we consider full employment. So there isn't really a catalyst to kind of push employment much further, which would mean there isn't a catalyst to really push expenditures much further. Here's a look at non-farm payrolls, all-time high. Moving forward, civilian labor force pretty much at its peak. So if you have employment, non-farm payrolls, adding all those individuals on the payrolls, then you have civilian labor force. This gives you the unemployment rate. At 3.8%, we're starting to see a slight slowdown from its bottom, I guess you'd call it, when we were about 3.4%. There isn't much more growth potential there, which means we're probably not going to see much growth with unemployment number this Friday. As well, we're probably not going to see continuing growth. But when they say GDP's kind of softening, it's above 5%. So kind of softening from a really high level. So I don't really look at that as a bad number. GDP needs to come down to get into more inline numbers. Here's a look at the S&P 500 over the weekend, the weekly chart. And as you can see, we probably have peaked. If interest rates do trend higher, they were about 4.62% is what I think I saw on the US 10-year today. But the stock market today, as I showed the chart earlier, kind of sideways, sold off a little bit, spiked right back up, slightly ticking higher for the day. If interest rates continue to trend slightly higher, this will affect the overall broader stock market. I'm looking for some kind of movements downward in the stock market. From there, I expect that we'll start to see the response from higher interest rates for a little longer than the market expected. From that, bond yields will start to fall down and stocks will probably start to move back upward. The big if in all of this is simply this. Where do we see what it takes to push this economy further, faster, to get some accelerated growth rates? The Federal Reserve right now can't even lower interest rates because the economy is moving around GDP over 5%. That is pretty high, even though it's lower than it was the quarter before. So that's something you have to keep in mind. We'll probably see the stock market moving sideways after it kind of bottoms out a little bit. I am looking for probably sub 4,800 in the S&P 500, maybe a range of about 4,200 to 4,800 in the near term sideways movement. At the same time, if inflation pressures start to ease, the Federal Reserve would be able to lower interest rates somewhat, kind of giving consumers a break, and that could perpetuate economic growth, but at a slower pace, which means a lot of these stocks might actually go nowhere because there's no real growth potential there. Those bond yields, that's something to kind of consider when you're thinking about an investment. Something I've been jumping into is the US 10-year. I've been using TLT stock, simply put. Eventually, this chart goes downward, which means TLT stock moves upward. This is interest rates on the US 10-year Treasury. TLT trades off the 20 and 30, of course, the longer dated, but the 10-year is a good in-between period from the 2 and the 20. If interest rates trend back down lower to say 3.5%, I'm probably going to pick up a good 30% on my TLT trade. I'll take that all day long. While I'm taking that, the stock market's probably going to move sideways. And that's when, as a value investor, I'm going to start stepping in, buying more stocks, looking for that sort of bottoming out where the Federal Reserve says, yeah, we need to kind of lower interest rates to kind of perpetuate where we are. Not accelerated growth rates, but growth. From there, modest growth, what we'd be used to. The stock market's move over the past, since what, November, is kind of historical. So if you are sitting on profits, maybe you want to kind of think about that with regard to maybe protecting those profits or taking profits, however you want to move with that. I'm looking for a modest move lower in the S&P 500, sideways movement. Eventually, TLT stock, the one I'm going long, does go upward. Then I'll start buying into stocks once again. Friday's number, for me, probably going to be a little soft. Wednesday, Federal Reserve, inflation numbers are simply not, we're not confident that inflation's getting to the point where we want it to be just yet. And that's going to be kind of their hedging that, like, listen, we're going to keep interest rates higher for a little bit longer. That's how that's going to break down. My take for this week. It is going to be an important week. Earnings numbers are coming in. They're pretty strong with some of the companies. I do have a write-up on this on my Substack. It is down. The link is down below in the description. If you want to find out what I think about the stock market today, make sure to click on that. And on a regular basis, I send out information on that. In the meantime, if this is your first time finding my channel, make sure to hit the like and follow button, and I'll break down the economy and how it affects the stock market today on a regular basis. We'll see you in the next video.